Now, Indian markets are scaling fresh record highs and GDP growth continues to surprise on the upside. But the rupee is telling a completely different story. On Monday, Indian benchmark surged to new all-time highs before powering those gains on weak global cues. The Sensex reached a second intraday peak of 86,159, while the Nifty climbed to a lifetime high of about 26,326. That surge in stocks early on Monday was largely driven by domestic investors. However, the rupee continues to falter, trading near its record lows. The currency has fallen to repeated new all-time lows despite the latest data showing the economy expanding at a faster than expected pace of 8.2%. Weak trade flows, absence of a US-India trade deal, and over $16 billion of foreign investor outflows have kept the rupee under pressure. India's trade deficit is at a record high and reliance on imported crude continues to push up dollar demands. A deep dive into the over 3-decade journey of the rupee gives us a compelling narrative. In 1991, due to a severe balance of payments crisis, India undertook economic liberalization that included a significant devaluation of the rupee to about 17.9 rupees per dollar. The correction back then reflected economic reforms like tariff reductions and encouragement of foreign investment. Now, as a result, the IMF has tempered expectations around India's dollar GDP. The fund downgraded India's national accounts data quality to a C from B grade, citing methodology issues and data gaps. IMF experts, they suggest that India will cross $4 trillion in 2026 and reach just under $5 trillion by 2028, almost $200 billion lower than earlier projections. Now, every round of rupee depreciation makes India's dollar GDP appear smaller, even if the domestic economy is growing strongly in rupee terms. Economists say a calibrated depreciation is now inevitable, with the IMF projecting the rupee around 87 in 2026 and 87.7 in 2027. The fund does not see a crisis but warns of periodic pressure from global uncertainty, tight financial conditions, and trade shocks. India's long journey from 17 rupees a dollar in 1990 to nearly 90 rupees a dollar today reflects higher inflation than the US persistent trade deficits and the heavy oil import bill. The country, which is the world's second largest consumer of crude, imports over 85% of its needs. Unless the currency stabilizes, the weaker rupee could delay India's ambition to become the world's third largest economy, even as growth and markets continue to outperform.